the record button. I don't think we will be a big class at all. So I think we might as well get into it. Okay, guys, much like last semester, we have few sessions. We have few sessions between ourselves. So, these sessions that we have, I think we only have 9 double sessions together. So I think the best way to approach this is to just say, guys, let us use this as more of recaps than anything. Okay, we do know this is a phase out module, right? So you guys are going to have to be doing the heavy lifting, doing the exercises and stuff like that. But I do know that you guys have been through this module, if I'm not mistaken, before. So it's all good. All right, it's all good. So you guys should be fine in terms of getting it done. Okay, so yeah, what I would say, I'm telling you this now, is that for Friday, let's prepare, go through exercises for unit 2, so that when we meet, you can obviously ask me questions on the different exercises and so forth. Okay, because I won't have time to go through everything with you or can conduct it like a usual class. Okay, that said, let's get into the slides for the topic Learning Unit 1. And as you can see on my screen, Learning Unit 1 is entitled Budgeting and Standard Costing. Okay, budgeting and standard costing. Okay. So now here, what is happening over here is pretty simple. Is we're talking about budgets. And budgets in today's dynamic world, predicting the future becomes an audacious affair, often requiring managers to plan far in advance so that unnecessary bottlenecks and lurking pitfalls can be avoided. Okay, so what are they talking about? Budgets. And as much as we're trying to predict the future, it's not easy to predict the future, but we still need to do it. Why? Because we want to avoid uh, any pitfalls or unnecessary bottlenecks, things that slow down the process of our business. Okay, right. So that's a budget. But what is a budget? We need to begin to ask ourselves that question. What is a budget? All right, and why is it important? Okay, budgets are financial plans, all right, as to where we plan to apply our resources. Okay, now it's usually management that make use of budgets because management are the ones that decide where we are going to allocate resources and how much of these resources we're going to allocate to these different activities or equipment and utensils and so forth for the business. Okay, all right. So the main elements of management are planning. Okay, we obviously are planning, and then we are organizing, and then we are activating or leading, and then we're controlling. I'm sure you guys may have come across this in your various management modules. Okay, so budgets form an important part of planning and control. Okay, they can be used as a tool for future planning as well as a tool for exercising control over cash receipts and payments, and also income and expenditure. And we'll see some of that today as we, touch on a few exercises, discuss them. I think that would be the easiest way of ensuring that we actually cover material by just, discussing the exercises at least, so that you get a feel of how they might ask you the various questions. And that's always critical, that you not only understand what the content is all about, but also that you are in a position to answer the questions. Okay, I give you my slides. That stuff is available to you, so don't worry about that. I'll upload them by this weekend. You'll have all my slides. Okay, I might not be able to do it in the week because sometimes, it just takes a bit longer. to get these things done than I'd like, but and there's a lot going on this week, it being the first week, but I will definitely get that to you guys over the weekend. Then why do individuals prepare budgets? Okay, so now we're talking to individuals such as yourself and myself. Why do we prepare budgets? So that we can track our spending, or at least try and plan where we're going to spend our money, all right, so we don't end up spending it too quickly. So if you're working, you have money for fuel to get to work and get back. You have obviously your rent paid and whatever other essentials you need to take care of. Okay, right. And then cash budget of a business. Prepare cash management. Sorry, proper cash management is paramount to the success of any business. All right. Funds could be depleted in no time if management does not ensure adequate control thereof. It is thus imperative that the business makes a proper estimate of future cash flows to ensure that the business does not fall into a debt trap. Okay, what is a debt trap? I'm going to just tell you here now. I do know in the slides along the way it does talk to a debt trap. And I think in the first Finance 1A, or sorry, 2A, I think we spoke about debt trap. But basically, debt trap, we're talking about when we over borrow, when we borrow money from creditors to buy stock, but then the stock isn't moving, and then we have to actually pay for that money that we borrowed, but we can't pay for it because all our money is tied up in that inventory. Okay, so that's the debt trap. We have bought the stock that we need to sell to our customers, but then we obviously don't have any money to pay for that debt because it is all in stock and we haven't sold any of the stock that we spent the borrowed funds on. Okay, right, but let's proceed. Then we have the cash budget of the business. Okay, so here now they're stepping into different types of budgets. All right. Remember, a large portion of a business's sales could be on credit. Important. This could mean the firm has attained significant profit, but that the cash has not yet been received from debtors. Okay, so this is now speaking a bit to what I was saying. Sometimes a business can be very profitable, okay, but all of the money that it's making on paper, at least, is tied up in debtors. So it hasn't actually realized this cash, okay? And that's a problem because while we have made these sales, we also need cash to pay for expenditure, to pay for salaries, to pay for regular operations, all right? To make sure that the business can take care of its day-to-day activities, okay? So if all our money is tied up in our debtors, then it becomes problematic because we can't actually run the business, okay? And that too forms part of the debt trap, just from a different perspective now. Hence, why an important section of the cash budget is the schedule of budget receipts from debtors, okay? So we did do, what is it called again? We did do a bit of budgets in 1A, in 2A, sorry, where we did the budget receipts, and there we were seeing how much money would be realized in each month. Okay, and we'll do a recap of that because we do that again here in 2B when we go through some exercises, when we brush through some exercises. Okay, but so that's very important to do a cash budget because we need to know how much money are we going to have and when. Okay, the main reason for preparing budgets is to ensure unexpected surprises do not have detrimental effects on the business. Again, remember, we want to avoid unnecessary pitfalls. In addition to the above, reasons for preparing budgets: to assist in planning of annual operations, to coordinate activities of the various departments, all right, to communicate plans to the various departments as well, or departmental managers, all right, to motivate managers and workers to achieve or surpass the goals of the organization. Control activities: if we see that there's over expenditure happening, what are we going to do? We're going to address or speak to that department, obviously warn them, obviously return goods if we've already, significantly surpassed that which we plan to spend on those particular initiatives or activities. All right, and then we also use it to evaluate. How have we performed? How have our managers performed? How have our employees performed? Have they hit targets? Have they surpassed targets? All right. Have they done so within budget? Have they done so out of the budget? Or have they exceeded the budget, should I say? Okay. All important questions. Okay. Then the budget process. Okay. We have reflected on the preparation of a cash budget by a business. We will now explore some of the other budgets that form an integral or holistic budget called the master budget. Remember, I told you there's different budgets, okay? And I think we got into some of this in 2A as well. We have the production budget, we have the sales budget, and you'll see those things come to play again here as well, okay? All right. So obviously the respective departments will put forward their budgets. Then management will look at those budgets and then approve them, and so forth. Okay. So step one, formulation of a budget committee. That's the first thing that takes place in the process of creating a budget. These are the guys who will approve the budget at the end of the budgeting process, the committee. They will also relay what is important for each department or group to include in the budget. Okay, they will communicate the goals of the organization to everybody involved. They will also resolve conflicts. Okay, the budget committee is the highest authority in the organization for all matters related to the budget. All right, monitors operations against the budget throughout the year, reviews operating results, approves major revisions of the budget during the period. Okay, and then we have choosing a budget period. Budgets are usually prepared in certain periods, okay? Most commonly 1 year. An organization's budget period will normally coincide with the financial year, okay? Because it is then easier to compare actual results with budgeted results. Okay, okay, yes. So here they're just saying that our budget will be in line with our actual financial year so that we can compare results, okay? And also for control purposes, the budget period will be broken down into small periods such as monthly, quarterly, 6 months, and obviously annually as well, all right? But primarily we're breaking it into those smaller periods so that we don't want to wait a whole year if we're overspending. We want to obviously address that as soon as possible, okay? Then we have significant number of firms are using a continuous budget, a budget system that has in effect a budget for a set number of months, okay, quarters or years at all times. Thus, as a month or quarter finishes, the original budget is updated based on the new information that becomes available. all right, and the budget for the new month or quarter is added. So here what they're telling us is that some businesses have a continuous budget, all right, system. And so basically, the reality is that we live in a world that is ever changing, and these days is changing all the more quicker than it used to in the past. Okay, as a result, we may make a budget based on certain assumptions, but those assumptions can change so quickly and so swiftly. So as a result, like for instance, when COVID first came in, that obviously changed the game for a lot of companies. None of us were planning or anticipating it. So as a result thereof, that then obviously needs to be incorporated in our budgets. Okay, so we need to make adjustments to the expectations of the things we thought we could achieve, the things we thought we could afford, because obviously we weren't making as much sales as we were in the past. Okay, so that's a continuous budget for you. All right, then development of budget guidelines. So this is what I was talking about earlier, where the committee, all right, also needs to consider developments that have occurred since the adoption. Okay, well, yeah, this is if you're operating under a continuous budget, which most businesses should be or are, all right, but generally the strategic plan needs to be communicated. The general economic environment needs to be considered. Special mandates, okay, are we downsizing? Are we re-engineering our whole structure? What's happening? Okay, so all these things need to be incorporated into our strategic budget, all right, as well as our plans. Okay, then preparation of an initial budget proposal. Okay, so here we're basically just talking to there are internal and external factors to consider when preparing the initial budget proposal. Some of the internal factors: changes in availability of equipment or facilities, adoption of new manufacturing processes, okay, introduction to new products, right? All these things that are taking place in the business, all right? Things that we said we are going to do. We're going to introduce a new brand. We're going to introduce a new set of products, all right? We're going to change our product mix, all right? All those things will affect our budget, and as such, we need to obviously incorporate those internal factors. Okay, I think you guys can read through the rest of them. All right, then if we look externally, changes in the labor market, all right, maybe new policies have come into play in relation to certain professions, all right, the minimum wage will have an impact, availability of raw materials. Okay, all this time we're a jewelry store, we've been working with gold to make our jewelry. Now, if obviously that jewelry gold is no longer available, all right, due to maybe mines shutting down, all right, or whatever else, then guess what? We then obviously need to incorporate those external factors and see how then can we continue to operate our business efficiently. All right, and as such, that's obviously going to impact our financial budget. Okay, all right, then industry. The industry's outlook for the near term. All right, if for any reason we no longer are able to import the equipment that we need to cut our jewelry, okay, you'll find there'll be less players in the market, okay, or there'll be significantly higher charges to importing this equipment because it's now scarce, okay, so that obviously is going to impact our budget. Okay, with the initial example I gave, if people are leaving the market, then we could anticipate potentially higher profits if we have all the equipment necessary, because we'll stay in the game and people will have left. That means we have now more market share, for example. And then competitor actions. Okay, now if the opposite were to happen, and there's less barriers to entry, guess what? That means we'll have more people within the business, within that sector. And as a result, then obviously, if there's more competition, that means less market share, or could potentially mean less market share. So how do we incorporate that into our budget? All right. Let's keep it going. Then on the 17th slide there, budget negotiation. So this is just now a slide speaking to the fact that, obviously, we as a certain manufacturing department within the business, we put together our budget, we propose it to management. They obviously will be back and forth just in terms of, okay, is this really necessary? We'd like to see you cut this out. And we will then justify as to why we think we should keep it in the budget, and so forth. Okay, so that's another step within the process. Then there's review and approval. Okay, the committee reviews the budget for consistency with the budget guidelines and against the overall strategic plan. Okay, the budget committee gives final approval, and the CEO then approves the entire budget and submits it to the board of directors. Okay, then revisions. Okay, so here we're now talking about continuous updates by means of monthly and quarterly revisions. Okay, things change. We can't keep the same budget when things have changed. Okay, but I think we've spoken to that already, so we need to be dynamic and be able to adapt. Okay, right, but let's go on. So here we're just looking at the definition of a master budget. Okay, and it is a comprehensive, all-encompassing budget for the enterprise and comprises many interrelated budgets, including both the operating and financial budgets. The master budget is the document that an organization uses to carry out its strategic plan to meet its goals. The master budget is often called a static or fixed budget because it stays the same when the volume of activity changes. Okay? Okay. So just some side information that they might ask you a question like, what is the static or fixed budget? Okay. The master budget is essentially a summary of the financial projections contained in the operating and financial budgets. Okay. So here they're now telling you what the operating budget consists of. You've got sales, okay? You've got the sales budget, you've got the production budget, subdivided into direct materials. Okay, and I think there's what, direct materials, and then what's the other one? I'm forgetting this now. Okay, but we'll see the production budget. There's direct materials, and I think it's direct labor. I think that's the one, yes. Then the sales and administrative expenses. Okay, so those all comprise, those budgets are all subdivisions of the operating budget. Then financial budget consists of the following subdivisions. You've got your capital budget, your cash budget, all right, then your statement of comprehensive income or your income statement, okay, budget, and then you have your budget of financial position or your balance sheet budget. Okay, and you can see those in your textbook, all right, under example 1.4. Okay, so you guys can have a look at that there. Okay. All right, then monitoring performance against the budget. Okay, so now here they're talking about variance. Okay, and I think we spoke to variance towards the end of Finance 2A. Okay, and variance, again, we're just saying what was there a difference between what we anticipated, in other words, what we budgeted, versus what actually happened? Okay, that's all we want to assess or see. Was there a variance? Was there a difference between what we actually budgeted and what actually happened? Okay, and is that difference, was it positive or negative? Okay, it could be either or if there's a difference between what was planned and what actually happened. It's all a question of, was it an expense or was it an income? And was it a favorable difference or an unfavorable difference? Okay, I think I skipped one there. Okay, standard costing for a manufacturing for a manufacturer. Okay. Actual costing system makes use of actual costs incurred for all product costs, including direct materials, direct labor, and manufacturing overheads. This is pretty much the same as traditional costing that we saw in 2A. Actual costing systems are often not preferred since they tend to produce unit costs that fluctuate from period to period, or even from batch to batch. Most actual factory overheads costs are known only at or after the end of the budget period. Okay, remember, this is why we have to do the whole allocation rate. Okay, because if we don't want to just be able to price something at the end or after the fact. We want to also be able to anticipate, or try and plan expenditure during the course of these periods. Okay, most actual factory overhead costs are known only at or after the end of the budget period, rather than at the completion of the batch of products. Thus, actual cost systems cannot provide accurate or unit production cost information on a timely basis. Okay, which is just speaking to what I was saying in a different set of words. We need this thing more timely. Okay, we don't want to wait for the end of the whole thing. Standard costing for me. A normal costing system makes use of actual costs for direct material, direct labor, and normal cost for manufacturing overhead using predetermined rates. This is what I was now talking about, the allocation rate. All right. Predetermined manufacturing overhead rates are assigned to cost centers based on your predetermined manufacturing application rate. All right, we did this in ABC, okay, activity-based costing, all right, towards the end of 2A, sorry, and the activity center. Okay, how? The predetermined manufacturing overhead rate is calculated by dividing the budgeted annual factory overhead costs by the budgeted volume or activity levels. We also were doing that in activity-based costing, okay? All right, unlike the actual costing system, a normal costing system does provide a timely estimate, okay, of the cost of products, each batch of the product, okay? Then we have standard costing for a manufacturer. Okay, okay. Standard costs are predetermined costs or target costs that should be incurred under efficient operating conditions. In a standard costing system, actual costs are measured against the predetermined standard costs to establish any variances. Okay, all right. All right. Establishing standard costs. Standard costs are set for each of the following cost elements. There's direct material, direct labor, variable costs, fixed overhead. Okay, we've seen this stuff, so this is more of a recap than anything else. The success of a standard costing system depends on setting accurate and reliable standards. And that's where things get tricky. It's not always easy to accurately and reliably predict the allocation rate, all right, for these respective costs. Okay, that's where things get a little bit tricky. Okay. Then we have, now here they're just talking about direct materials. Okay, that's the actual materials used to produce the product. All right, then they're talking about direct labor, the actual labor to sew the Nike shoe together. Okay, then they're talking about variable overheads. What are the different small costs that went into, should I say, what are the different, sorry, excuse me, what are the different costs that went into manufacturing that shoe? Okay, we needed certain things, costs that were incurred, all right, per product, all right, for that specific shoe or product. Then we have fixed overheads, all right, fixed costs are assumed to be more or less constant, all right, irrespective of the level of output. So basically, like rent we know is a fixed cost, whether you are staying in the house or not. As long as you sign the lease, you are going to have to pay the rent. Okay, all right, so those are the type of fixed costs that we are talking about. Okay, then variances. A variance is the difference between the standard cost and the actual cost of producing a product. Okay, we spoke to variances. Okay, then we have different types of variances. We have the machine price variance, material quantity variance, labor rate variance. Okay, these are things we have seen already in Finance 2A. Labor efficiency variance, but here they like to ask it a whole lot more. So you have to be on top of your game here. Okay, variable overhead expenditure variance, variable overhead efficiency variance. Three cost elements in the manufacturing industry. Okay, go to direct material, direct labor, and your overheads. Okay, those are the three costs that you get. Okay. All right, and then here they're basically just informing you that direct material and direct labor make up prime cost of the product. All right, and direct labor plus manufacturing overheads is known as conversion cost. Direct labor plus manufacturing overheads. Okay, it might be noteworthy that a service industry has cost elements, namely labor and overheads. Okay, these two elements are directly compared with conversion costs in a manufacturing industry. Interpreting favorable and unfavorable variances. Whether the answer is positive or negative is irrelevant. What is important is whether the movement is favorable or unfavorable. This is what I was saying earlier in terms of variances. That it all depends. Let me see how many. Okay, we have quite a few slides here. It all depends on that variance. How exactly did this variance impact us? So if we spend less on bottled water than we thought we would, so for example, we say we thought we were going to spend 10,000 on bottled water for the year, but it turns out we spent 8. Can you see? That's a favorable movement because we spent less than we anticipated. Okay, if we spend 12,000 on bottled water, can you see that's a negative movement or an unfavorable movement because we spent 2,000 more than what we anticipated. Okay, so you have to ask yourself, is this a cost or is it an income? That tells you whether the movement was favorable or unfavorable in our regard. Okay, Right, and then here we are getting now the formulas, okay, for material price variance. Okay, okay, right, then cause of material price variances, then material usage variances, okay, and then the explanations as to why something may be favorable or unfavorable. These are things that you should just know. You shouldn't need to cram them. Okay. Right. Okay. I think I inserted a table here towards the end. So they can give you this formula, make you do the calculation, then they can ask you to explain, state whether it's favorable or unfavorable, and then explain why it is favorable or why it's unfavorable. Okay. All right, then here you've got the total labor variance. Okay, same principle. Then they're taking you to the manufacturing overhead variance. They're defining that, talking about it. Okay. Okay. Right. Then fixed manufacturing overhead. Okay, the causes. Okay, and there you get a nice summary, all right, of your material variances. And then a nice summary of your labor variances. And then finally a summary of all of the manufacturing overhead variances. Okay, and that is your learning unit 1. Okay, so I think for now let's stop there. Okay, I think let's stop there, and then let's take a quick break. I think actually a long break actually would be best. So let's have a break there until, let's say, until 3. No, not 3, sorry, until 2. Okay, and then after the break, we will then proceed to just go over some exercises in Unit 1, how they can structure some questions. We can look at what they asked, look at how the questions were answered, and then we will call it a day for today. Okay. So again, what I would recommend is that we obviously, you go over the unit in your own time, and when we get together, that's when you come, you ask me questions, and then we engage, all right, so that it's not just me talking the whole time. Okay, but that said, let me not hold you any longer. Excellent. Let me see you at 2 o'clock. All right, no problem.